Today in this video, we will learn about what is sector analysis, how does it work and why it is important. So, what is sector analysis? Sector analysis is an assessment of the economic and financial condition and prospects of a given sector of the economy. Sector analysis serves to provide an investor with a judgment about how well companies in the sector are expected to perform. So, how does sector analysis works? Sector analysis is based on the premise that certain sectors perform better during different stages of the business cycle. The business cycle refers to the up and down changes in economic activity that occur in an economy over time. The business cycle consists of expansions, which are periods of economic growth, and contractions, which are periods of economic decline. Early in the business cycle during the expansion phase, for example, interest rates are low and growth is beginning to pick up. During this stage, investors or analysts who do a sector analysis would focus their research on companies that benefit from low interest rates and increased borrowing. These companies often perform well during periods of economic growth. These include companies in the financial and consumer discretionary sectors. Next, we shall see types of sector analysis. Two common approaches to sector analysis are the top-down and sector rotation approaches. First, we have top-down approach. Investors who employ a top-down approach to sector analysis focus first on macroeconomic conditions in their search for companies that have the potential to outperform. They start by looking at those macroeconomic factors that have the biggest impact on the largest part of the population and the economy, such as unemployment rates, economic outputs, and inflation. They then drill down to find those sectors that perform best during the prevailing economic conditions. Lastly, they analyze the fundamentals of companies within those sectors to identify stocks that offer the best potential for future profits. Next, we have sector rotation approach. Investors and portfolio managers use a sector rotation approach to rotate their investments depending on market cycles and trends that influence the profitability of some sectors over others. For example, the investor might rotate in and out of cyclical stocks and defensive stocks before the end of the year holiday rush to take advantage of stocks that benefit from increased consumer sales. Then, we have sector taxonomy approach. In this approach, investors globally rely on green taxonomies for their investments. The only green taxonomy we have in India is the ORF Green Taxonomy 2022. A green taxonomy can help to promote social responsibility by encouraging investment in activities that support sustainable development like affordable housing, access to clean water, and sustainable agriculture. You can contact us from the details mentioned on the screen via a call, WhatsApp, or email. Thank you for listening the video to the end. Please do like, share, and subscribe the video for the latest updates in the market.